If you think financial danger only comes from foreign shocks or Wall Street crashes, listen closely because sometimes the threat is closer, quieter, and dressed up as a safe, patriotic path to wealth. In a report published by Forbes, more than $100 million in real estate assets are alleged to have disappeared inside an American investment operation that marketed itself as a straightforward way to get rich with property. The story centers on RAD Diversified, based in Tampa, Florida, and Forbes describes a growth machine built on seminars, digital marketing, and a promise that feels almost irresistible. A non-traded REIT buying single-family homes in major U.S. cities, plus Opportunity's own funds, a crypto NFT product, and even a members-only inner circle that reportedly cost $50,000 just to enter. Then comes the detail that should make any investor's blood run cold. 2 weeks after a retired U.S. Army officer who had worked in psychological operations joined the company, Forbes reports that the CEO asked him to study how Bernie Madoff was caught, not how to avoid it, not how to protect investors, but how he was discovered. By late 2023, as mortgage rates climbed toward 8%, the slowdown story sounded plausible. But in February 2024, the report states that the SEC moved to suspend the REIT's fundraising and the company froze investor redemptions, trapping money in place. And by July 2025, Florida's Attorney General publicly said it appears to be a Ponzi scheme. So here's the threat directly to you. If your money can be locked behind redemption gates the moment fear spreads, your safety is an illusion until the day you try to exit. Picture the moment your money stops behaving like your money. Not because you made a bad trade, not because the stock market had a rough week, but because the investment you were told was stable suddenly flips a switch. Distributions slow, then vanish. Loan interest doesn't show up. Statements turn into a blur of fees. Communication dries up, and when you try to pull your cash out, you discover something most people only learn when it's too late: the exit is not guaranteed. According to Forbes, that is exactly the kind of trap investors say they fell into with a Florida-based real estate operation called RAD Diversified. This isn't just a scandal story, it's a warning about a system that can look perfectly legitimate until the day it doesn't. A system built on financial products most everyday investors barely understand, marketed with confidence and community, wrapped in real estate's can't-lose mythology. According to Forbes, the allegations include missed payments across RAD-related products, properties sold without warning to partners, and most alarming claims from an investor with access to the books that there were foreclosures in the portfolio and assets estimated around $100 million that appeared to be missing. And here is the part that should focus your attention. This didn't unravel during some distant, abstract financial crisis. It unraveled in the real world of rising mortgage rates, where a slowdown can sound like a normal market excuse. According to Forbes, by the end of 2023, mortgage rates were nearing 8%, and RAD blamed cash pressure on a broader slowdown in home sales. An explanation many investors initially accepted because it fit the macro environment, but then the timeline turns into a lock-clicking sequence. According to Forbes, in February 2024, the same day the SEC suspended the RAD Diversified REIT's ability to raise new funds after declaring its offering statement, abandoned RAD froze investor redemptions. That's not a market fluctuation. That's a structural feature of certain private products, the ability to restrict liquidity right when investors need it most. And in July 2025, Forbes reports that Florida's Attorney General James Youthmeyer announced subpoenas after receiving complaints that investor money was not being used as advertised and publicly stated. This appears to be a Ponzi scheme. If you're thinking, I'd never fall for that, that instinct is exactly what this episode is going to challenge, because the mechanism isn't just greed, it's design. According to Forbes, the RAD ecosystem didn't revolve around a single simple investment. It included partnerships, a non-traded REIT, and lending opportunities that reportedly promised returns above 10% per year, while the company marketed a real estate portfolio supposedly totaling $250 million. This is how modern financial marketing works. It doesn't sell you one decision. It sells you a ladder one rung at a time until you so invested emotionally and socially that leaving feels like betrayal of your own identity. And Forbes describes a striking detail about the internal culture. A retired U.S. Army officer, Michael Carr, hired to help the company scale, was asked by CEO Brandon Dutch Mendenhall to research how Bernie Madoff, the most notorious Ponzi operator in history, was caught. Carr's takeaway, according to Forbes, was that Madoff stayed undetected because he kept details out of view and because nobody wanted to spoil magical returns by asking questions. That is not a throwaway anecdote. It's a signal about incentives. When a product is opaque, when pricing is not transparent, when liquidity is limited, and when returns are sold with a story that discourages scrutiny, the investor loses the one weapon that matters: verification. And this is where the threat becomes personal. Because even if you never invest in this specific company, the broader structure is everywhere. Private deals, alternative funds, non-traded products, and exclusive memberships that promise access to wealth most people can't reach. These vehicles often rely on trust more than transparency. and trust can be manufactured through seminars, social proof, charismatic leadership, and the feeling that you've been invited into the room where serious money is made. Forbes frames the RAD case as part of a wider post-2012 landscape. After the Jobs Act provisions, like Regulation D and Regulation A+, helped create pathways for companies to raise large sums without going through a traditional IPO, with lighter disclosure requirements and looser marketing rules. This is not inherently illegal, but it changes the balance of power. Less disclosure means less friction, and less friction means more room for aggressive storytelling. And then there's the product category that sits at the heart of this episode, the non-traded REIT, according to Forbes. Unlike publicly traded REITs which trade on open markets, file regular SEC reports, and have easily verifiable share prices, and traded REITs often limit redemptions, offer significantly less transparency, and can carry high fees. When the market is calm, that friction is easy to ignore. When conditions tighten, that friction can become a trap. If you want a human face for what trap means, Forbes includes investors who describe watching their deals degrade in slow motion. One retired businessman, Tom Nagy, told Forbes he committed roughly $330,000 into 4 residential partnerships, plus a $100,000 loan to RAD, and additional exposure tied to a golf club investment connected to the RAD orbit. He expected rental income and interest. He says he got neither. He says statements listed fees and repair costs he couldn't substantiate. Invoices were not provided when requested, and he was later told the properties had been sold, yet he recovered only $1,900 out of the $330,000 invested. Another investor, Lonnie Phillips, described believing he had entered a true 50/50 partnership structure only to later discover, he says, that RAD had sold much of its stake to another RAD investor without his knowledge, undermining the incentive structure he thought he was buying. And when the property sold, he says none of the investors received proceeds. So when you hear real estate, don't hear safety, hear a question. Who controls the information? Who controls the liquidity? And what happens the day everyone tries to leave at once? Because that's exactly what this episode is about. In this video, we map the architecture of these businesses, how over-the-counter vehicles transformed into a gigantic market, how the post-2012 fundraising era changed incentives, and why rising interest rates act as a stress test that may reveal what has always been hidden. Before we go deeper, if you want more documentaries that expose the hidden mechanics behind money and power, hit subscribe, leave a like, and tell me in the comments, what city and country are you watching from? Your support is what makes it possible to keep producing more episodes like this. Let us start with the mechanism, because the threat to you isn't just bad actors. The threat is a structure that can legally trap your money while you're still being told everything is normal. According to Forbes, RAD, diversified S-Corp pitch, revolved around a not-traded REITA, private real estate investment trust, that claimed it was buying single-family homes in major U.S. cities. Alongside that, Forbes reports the business offered Opportunity Zone funds, a crypto NFT fund, and even an exclusive investment club that cost $50,000 to join. Then there were loans to the company itself, allegedly promising returns above 10% a year. While the company marketed a $250 million real estate portfolio, that mix matters, because it creates a ladder of commitment, a membership community, then a fund, then partnerships, then loans. You don't just invest money, you invest identity. You invest trust. And once that happens, the easiest person to deceive is the person who needs the story to be true. Now here's the key concept. Liquidity is power. Public REITs trade on open markets. Prices move every second. You can sell, even if you sell at a loss. But non-traded REITs operate differently. According to the SEC's investor guidance, non-traded REIT shares are not traded on public exchanges. And redemption programs, if they exist, are limited and can involve minimum holding periods, with liquidity often tied to a future event like liquidation or listing that can take years. And in the new generation of non-traded REITs, that liquidity constraint can be formalized into hard caps. According to wealthmanagement.com, some redemption programs are limited to up to 2% of NAV per month and up to 5% per quarter. That means even if nothing is wrong, there may not be enough liquidity for everyone to leave at once. So when people ask, how could investors get stuck? The answer is simple, because the product was designed to control the exit. According to Forbes, in February 2024, on the same day the SEC suspended the RAD diversified REIT's ability to raise new funds after declaring its offering statement abandoned, the company froze investor redemptions. That moment is not just a plot point. It says the mechanical center of gravity in this story. The instant the business loses the ability to bring in fresh money, investors lose the ability to get out. If you've studied financial history, you've seen this movie before, just with different costumes. In 2008, a major money market fund, a reserve primary fund, broke the buck, meaning it fell below the supposedly stable $1 NAV. According to Investopedia, that happened on September 16, 2008, and it sent shockwaves through markets built on the idea of safe, liquid cash. The point is not that a money market fund is the same as a real estate fund. The point is that when a product is sold as stable, but liquidity vanishes under stress, panic becomes rational. And regulators know this dynamic. According to the SEC, money market fund reforms in 2023 explicitly included removing redemption gate provisions while strengthening liquidity requirements, because gating can intensify investor fear and trigger runs. Now apply that to non-traded real estate. You're not holding treasury bills. You're holding properties slow to sell, expensive to refinance, and brutally exposed to interest rates. Which brings us to the macro trigger that made the RAD story feel plausible at first: rates. According to Forbes, by the end of 2023, mortgage rates were approaching 8%, making many investors believe RAD's explanation that real estate sales were slowing, and that macro backdrop was real. According to AP reporting based on Freddie Mac data, the average 30-year fixed mortgage rate reached 7.79% in late October 2023. Here's the threat to you. When rates spike, real estate doesn't crash the way stocks do. It suffocates. Transactions slow, refinancing dries up, debt service costs surge, and any business model that depends on continuous fundraising or rolling short-term obligations into new investor money starts to crack. And Forbes describes investor allegations consistent with that stress pattern: distributions slowing, and then stopping, missed REIT payments, unpaid loan interest, scarce communication, and even properties sold without warning in some partnerships. Now zoom out. The reason this story is happening in the 2020s is that the last decade built a giant industry around private access. According to Forbes, the RAD case is framed as part of the ecosystem created after the 2012 JOBS Act using Regulation D and Regulation A+, which can allow companies to raise large sums without a traditional IPO, with lighter disclosure and looser marketing constraints. And according to the FTC, the Jobs Act required the Commission to expand regulation, ultimately enabling offerings up to $50 million in a 12-month period under the updated framework. This is the trade-off. Access expands, friction drops, and the marketing machine gets more room to operate. Private REITs became a natural hunting ground for that era. According to Forbes, unlike listed REITs that trade on public markets and file regular reports, non-traded REITs limit redemptions, offer far less transparency, and often charge higher fees. And Forbes cites Blue Vault data showing how large this corner of the market has become. Non-traded REIT assets growing from $78 billion in the early 2010s to $178 billion in 2025. That's not a niche, that's a system, and systems create recurring failure modes. In the 1980s, the US learned what happens when real estate risk lacks oversight and aggressive growth collide. According to the FDIC's historical review of the era, official estimates put the total cost of resolving the savings and loan crisis at $160.1 billion. The details differ, but the theme is the same. When incentives reward fast growth and complex balance sheets, the truth becomes optional until the math forces it to become public. And that brings us to the most chilling signal in the RAD narrative. According to Forbes, a senior hire was asked by the CEO to research how Bernard Madoff was caught, and his conclusion was that Madoff stayed undetected by keeping details out of view and, because nobody wanted to spoil magical returns, by asking questions. That is not just dark irony. It's a blueprint. Opacity plus trust plus controlled liquidity. Because if you can't verify the assets in real time, and you can't exit on demand, you're no longer investing, you're hoping. And hope is not a financial strategy. It's a vulnerability. Next, we will analyze the strategy, the specific warning signs that repeat themselves throughout the cycles, how community marketing can replace transparency, how the promised high returns become a pressure cooker, and why increasing fees acts as a lie detector for any operation that cannot survive without new capital flows. What happened here doesn't start with a courtroom. It starts with a story, one that makes you feel smart for saying yes. According to Forbes, RAD didn't just sell an investment. It sold a path, seminars, digital marketing, a menu of options, and an exclusive inner circle that reportedly cost $50,000 to access certain deals. That structure is not accidental. It's a funnel, because the easiest way to get you to stop asking questions is to make you feel like you're no longer an outsider. You're an insider. You're part of a group that finally understands how wealth is built. And once you internalize that identity, skepticism starts to feel like betrayal, not just of the company, but of your own decision-making. Regulators have a name for that dynamic. According to the Sex Investor Alert on affinity fraud, scams often prey on identifiable groups and exploit the trust people place in leaders and communities they believe are like them. Even when the investment itself is real, the fraud can live in the lies, exaggerated performance, hidden conflicts, and opaque cash flows. Now, look at the performance pitch, because this is where the danger becomes mathematical. According to Forbes, RAD's leadership claimed a return of 150% in 4 years, and one reason a senior hire said he couldn't do his job was that the underlying numbers didn't hold together. Figures changed from one version to another, and different parts of the business didn't reconcile. In the same passage, Forbes contrasts that claim with a blunt benchmark over a similar period starting in 2019. Vanguard's real estate index fund posted a gain of about 18%. That gap should hit you like a siren. When someone sells you returns that massively outpace a broad benchmark, especially in an asset class as competitive and rate sensitive as real estate, there are only a few ways it happens. Either they discovered a repeatable edge nobody else can replicate, or the risk is far higher than advertised, or the accounting is doing the work that the assets cannot. And this is where the historical parallel matters. The too consistent, too good promise is a signature we've seen before. In the Madoff case, the story wasn't realist. It was a reputation machine, but the vulnerability it exploited is the same: trust replacing verification. According to the FBI's account of the case, Madoff ultimately admitted he was running a Ponzi scheme and told his family the firm was out of money before authorities were alerted. The lesson is not every high return is a Ponzi. The lesson is that when the details are hard to see, your confidence is being manufactured. Now add a second ingredient: controlled liquidity. According to Forbes, after investors say distributions slowed and then stopped hand after missed payments and unpaid loan interest, February 2024 becomes the pivot point. The SEC suspended the REIT's ability to raise new funds, and RAD froze investor redemptions the same day. That is the moment the product stops behaving like an investment and starts behaving like a locked room. And if you think locking the exits is rare, it isn't. In late 2022, a much larger and more established private real estate vehicle, Blackstone's BREI, began limiting withdrawals after redemption requests surged. According to the Financial Times, that wave of attempted redemptions exceeded the fund's withdrawal limits, and the fund used tools like asset sales and a large outside investment to manage liquidity. This matters because it proves a broader point. Even when there is no allegation of fraud, private real estate can legally ration liquidity under stress. So if you're sold a safe product with limited transparency and limited redemption capacity, your real risk may not be price volatility, it may be the inability to move at all when the environment turns hostile. Now let's talk about the third ingredient: intercompany complexity, money moving between entities. According to Forbes, one investor who became a board member says he gained access to bank accounts and once started reviewing transfers and balances, and what he saw raised immediate concerns about how money flowed between different RAD entities. He says he later lost access after being removed from the board. This is another recurring pattern across financial blowups. The more entities, the more explanations, the more moving parts, the harder it is for an outside investor to trace where your money actually sits, what it's collateralized by, and who gets paid first when cash runs thin. And here is the most direct threat to you. In a system like this, you can be right about the asset class and still get destroyed by the structure. You could be right that housing demand exists. You could be right that real estate is tangible. You could be right that inflation makes hard assets attractive, and still your capital can vanish into fees, opaque transfers, or obligations you didn't understand, while you stare at statements that never quite match reality. According to Forbes, an investor with access to the books alleged there were multiple foreclosures in the portfolio and that roughly $100 million in assets appeared to be missing. That allegation is enormous and still an allegation, but it points to the nightmare scenario investors fear, that the asset base you thought existed is not there in the form you believed. Now step back and connect the dots with the macro environment, because this is how these stories accelerate. High interest rates don't just slow home sales, they crush refinancing, they raise debt service, they punish any strategy built on leverage and constant inflows. According to Forbes, the company attributed cash pressure to the broader slowdown in real estate sales. And by late 2023, mortgage rates were nearing 8%, which made many investors accept that explanation. That's the perfect cover story, a real macro problem that can hide a deeper micro problem. And it creates the most dangerous psychological trap. You tell yourself it's temporary. You wait. You don't want to be the person who panics. You don't want to lock in a loss. You don't want to admit you might have been manipulated. Meanwhile, the machine survives on silence because if enough people demand documentation at the same time, the story collapses. So here's the question you should be asking right now about any private product that promises stability. Who is the independent custodian? Where is the third-party administrator? What audited financials exist, and who audited them? What are the exact redemption limits, and what triggers a freeze? How is the manager paid, and what incentives do fees create? And if something goes wrong, are you an owner with rights, or a passenger with hope? Next, we go in to pull this apart even further, using the classic warning signs that repeat across cycles, and I am going to give you a simple due diligence checklist you can run in minutes, before your money gets trapped behind a gate you didn't know existed. If you want the real lesson here, it's not avoid this one company. The real lesson is that a rate shock turns opacity into a weapon and it turns illiquidity into a trap. Because in the low-rate era, almost anything looks genius. Cheap debt makes refinancing easy. Rising asset prices mask weak cash flow, and new money can paper over old promises. But when the regime flips, when borrowing costs rise fast, every fragile structure gets stress tested at the same time. According to the Federal Reserve's own rate history, the Fed drove the target range up to 5.25% to 5.50% by July 2023 after a rapid tightening cycle. That wasn't just a headline, it was a shockwave through every leveraged strategy in America, especially real estate. And history is very clear about what high rates do to real estate balance sheets. In the 1980s, the U.S. savings and loan system imploded after a rate surge collided with a maturity mismatch institutions that were effectively funding long-term mortgages with short-term liabilities. According to the Federal Reserve's historical analysis, thrifts were a major conduit for U.S. mortgages, and the sector became highly vulnerable when rates rose. And according to the FDIC's review, the estimated total cost of resolving the S&L crisis was $160.1 billion. Different era, different instruments, same physics. When short-term funding gets expensive, long-term assets become a choke point. Now translate that to private real estate products today. A non-traded REIT is built on a liquid assets properties that cannot be sold instantly without price concessions. Yet many investors approach these products with a public market expectation. If I need my money, I'll just redeem. That assumption is the danger, because according to the SEC's disclosure guidance for non-traded REITs, redemption programs typically have significant restrictions, and non-traded REITs often have broad discretion to amend, suspend, or terminate those programs. And according to investor.gov, non-traded REITs are illiquid, and investors may have to wait for a liquidity event, sometimes more than 10 years, to get liquidity. Read that again? But as a threat, if you put your savings into a product with redemption discretion, you are accepting a possibility that your money can be locked precisely when you need it most, during a market stress, a recession, a health emergency, a job loss, or a sudden household crisis. And that's not theoretical. According to Forbes, RAD investors describe distributions slowing and stopping, missed payments, unpaid interest, and communication breakdowns followed by a moment that matters mechanically. In February 2024, after the SEC suspended the REIT's ability to raise new funds, investor redemptions were frozen. That is what an illiquidity event looks like from the inside. Not a crash, but a door closing. And if you think, well, regulators would never allow a system that traps people like that. Look at what regulators have learned the hard way across multiple asset classes. In money market funds, for example, the 2008 and 2020 stress episodes showed how fast safe instruments can face run dynamics. In 2016, regulators introduced fees and gates that allowed certain funds to limit withdrawals under stress. But by 2023, regulators moved away from that model, according to the SEC's July 2023 press release. The Commission adopted reforms that removed provisions permitting redemption gates. Why does that matter here? Because it shows that even in highly regulated markets, gating is recognized as a destabilizing flashpoint. Once investors believe exits can be restricted, the incentive becomes get out first. And when you apply that psychology to a liquid real estate, the pressure doesn't just increase, it can become existential. Now let's zoom in on the persuasion layer, because a product that can freeze redemptions still needs one thing to grow: your consent. And consent is manufactured through trust. According to the SCE, affinity fraud exploits the trust within identifiable groups, often using respected leaders or community ties to spread the message. The relevance is simple. When trust becomes the distribution channel, skepticism becomes socially expensive. You don't want to be the person who doesn't get it. You don't want to question the leader. You don't want to admit fear. That's how opacity survives. And at SY, the single most dangerous sentence an investor can say is, I trust them. Trust is not a substitute for controls. So here's what controls looks like spoken in plain English, as a checklist you can use before you wire $1 into any private product, any non-traded vehicle, any exclusive deal. Ask these questions out loud, and if the answers are vague, you walk. 1. Who is the independent custodian, and where are assets held? 2. Who is the third-party administrator? If reporting is produced in-house, your numbers are only as honest as the person printing them. 3. What audited financials exist in? Who audited them? Reviewed is not audited. We're working on it is not an answer. 4. What is the exact redemption language? Not the marketing summary, the actual document. According to the SEC, redemption programs can have caps and can be suspended. You need to know the triggers and the manager's discretion. 5. What is the fee stack? Upfront loads, management fees, acquisition fees, disposition fees, financing fees. Fees can drain performance even when assets are real. 6. How are valuations determined? If pricing is subjective or infrequent, you may be looking at numbers that lag reality, especially in a downturn. 7. What is the leverage profile? How much debt? What maturities? What covenants? What refinancing assumptions? In a higher rate regime, leverage is not a multiplier, it's a blade. 8. What related party transactions exist? Multiple entities can hide cash movement. When cash is tight, related party dynamics decide who gets paid first. 9. What happens if fundraising stops tomorrow? If the model depends on continuous inflows, it becomes fragile when markets tighten. 10. What is your legal position in a worst-case scenario? Are you senior, secured, unsecured, equity? Because in distress, structure is destiny? Now, here's the final reason this becomes a direct threat to you. Most people don't lose money because they failed to predict the market. They lose money because they misread the product. They think liquidity is a feature. They think transparency is implied. They assume regulation means safety, and they discover late that the rulebook they never read is the rulebook that controls their life. According to Florida's Attorney General, complaints alleged investor money wasn't being used as advertised, and the office issued subpoenas, stating publicly, "This appears to be a Ponzi scheme." That statement is about this specific case, but the structural risk is broader than any one headline. Next, we're going to take this checklist and turn it into a simple red flag score. A quick way to evaluate private deals before the deal evaluates you, by trapping your money behind a gate you didn't know existed. Here's the hard truth. What happened in this Forbes-reported case is not an isolated weird scandal. It has a stress test that shows you how the modern money machine breaks quietly while you're still being told to stay calm. Because when investors say income distributions slowed and then stopped, when REIT payments were missed, when loan interest wasn't paid, and communication went dark, the story still had a convenient excuse. The market is slowing. And yes, by late 2023, mortgage rates were pushing toward 8%, so that excuse sounded believable. But then the structure revealed itself. In February 2024, on the same day the SEC suspended the REIT's ability to raise new funds, the company froze investor redemptions. According to Forbes, that is when the door locked. And if you think that can't happen to you, I want you to hear this clearly. You don't lose in these situations because you're ignorant. You lose because the product was built to outpace your ability to verify it. According to the Sexone Investor Bulletin, on non-traded REITs, redemption programs, when they exist, are typically subject to significant limitations and may be discontinued at the REIT's discretion, sometimes without notice, and shares may be redeemed at a discount. And according to SEC disclosure guidance, non-traded REITs generally reserve discretion to amend, suspend, or terminate redemption programs, and those programs can have caps and funding limits. That means the most important sentence in this entire episode is simple. If you can't exit on demand, then return is not the first risk. Control is. So let us turn this into something you can use right now before your money gets trapped behind a gate you didn't fully understand. I call it the red flag score. 10 questions, 1 point each. If you score 3 or more, you slow down. If you score 5 or more, you walk no matter how good the pitch sounds. 1 is the product non-traded or privately priced. If the share price isn't set by an open market, you are relying on internal valuation. 2 is liquidity program based instead of guaranteed. According to the SEC, redemption programs can be limited, discounted, and discontinued. 3. Can the manager freeze or suspend redemptions? According to SEC guidance, many non-traded REITs reserve broad discretion to amend, suspend, or terminate redemption programs. 4. Are returns marketed as unusually high relative to broad benchmarks? According to Forbes, RAD claimed returns of 150% in 4 years while, over a similar period, starting in 2019, Vanguard's real estate index fund gained about 18%. 5. Does the operation sell belonging before it sells disclosure? Affinity-style marketing is not proof of fraud, but according to the SEC, affinity fraud exploits trust within groups and often spreads through respected leaders. 6. Are there multiple entities moving money around? Complexity isn't illegal, but it's where accountability goes to die. 7. Are the numbers inconsistent or hard to reconcile? According to Forbes, the internal figures changed from version to version, and different parts of the business didn't match. 8. Is the business relying on constant inflows? When fundraising stops, the real balance sheet speaks. 9. Is the product highly exposed to rate shocks? According to the Federal Reserve, the FOMC raised the target range for the federal funds rate to 5.25% to 5.50%. In July 2023, one of the most aggressive tightening regimes in modern history. 10. Is there a credible allegation that assets are missing or cash use is not as advertised? According to Forbes, Florida's Attorney General issued subpoenas and publicly stated, "This appears to be a Ponzi scheme." And Forbes reports an allegation from an investor with access to the books that there were foreclosures and approximately $100 million in assets appeared to be missing. Now, let me draw the historical line for you because this is not new. In the 1980s, the US learned what happens when real estate exposure collides with a hostile rate environment, the savings and loan crisis. According to the FDIC's historical review, one estimate put the total direct and indirect cost of resolving that crisis at $160.1 billion. Different vehicles, same vulnerability. When the regime changes, when money gets expensive, the structures that depended on cheap funding and easy liquidity start collapsing. And when the product is opaque and illiquid, the collapse doesn't look like a chart crashing on CNBC. It looks like an email that stops coming. It looks like a payment that doesn't arrive. It looks like processing delays. It looks like temporary suspension. It looks like you realizing, too late, that you don't own an investment to own a promise. So here is the direct threat to you. If you are shopping for yield in private products and untraded REITs, private real estate deals, exclusive memberships, high-interest loans, to operating companies, then you are operating in a world where the exit can be optional, and where verification is the only safety. And if you take nothing else from this episode, take this. Never outsource verification to charisma. Never outsource liquidity to marketing. Never confuse a document with a guarantee. Because the day the cycle turns, the first people to lose are not the stupid ones. They're the ones who believed the story was protection. And the last thing you want is to discover the truth at the exact moment your money is no longer allowed to move.